look at the bigger picture. Tony Drake's with us, CFP Drake and Associates. Thank you for being here today. Right, day after the Super Bowl, another record. Right, we saw the S&P hit a record, the Nasdaq 100 hit a record, the Dow hit a record. I'm not sure where we'll close today, but it really shows that people are unafraid to continue to make some investments this week as we kick off a new week. How do you feel about the market overall?
I think we're really in this interesting time period, Nicole. You know, as you mentioned, 5,000 for the first time. That's obviously great news. And when you look historically, the S&P 500 has been higher 1 year after crossing a major threshold. If you go all the way back to 1968, the last 9 times the broader index reached this new milestone, it was higher by a little over 10% on average 12 months later. So that's good news. It doesn't mean everything's rosy, though, right? We certainly have to keep on our eye on things. I mean, one thing we've learned post-pandemic is growth doesn't necessarily have to slow for inflation to curb. So the cycle is getting longer, but spending has not come down. Feds want to see that happen. Obviously, we're entering an election cycle. That can cause some turbulence for the markets. And we always have these wild geopolitical risks that we're watching, with everything going on all over the world.
Yeah, understood. So tell me about the different scenarios. I mean, the soft landing is the one that seems to be the most popular. Your thoughts on that, because that's what you're talking about, growth versus inflation. Tell me a little bit about the likelihood of a soft landing.
I think the odds are looking better. If you look at that revised inflation reading that came in lower than first reported, S&P 500 really moved with strong earnings and good economic news. And at the end of the day, we're still seeing this really great news on the economic front. Markets reacting to that. I think as this longer story plays out throughout 2024, more likely, if we continue to get some of that same news, that we're going to stick this soft landing here. But, there is a strong argument I think we have to consider that the Fed, doesn't need to cut rates right now. And how the market will react to that, I don't know. I mean, Jerome Powell's essentially promised us that he is going to cut rates. So if you look at all the real indicators and some of the advanced indicators, they haven't slowed down. If they do, then we might see rate cuts, but bull markets might not be dependent on those rate cuts. So we may need to start to separate that thinking and methodology.
I see. You say that they promised the rates, which they have, but not so fast, right? I mean, they allude to the fact that they're coming, but don't look for them in March, right? When do you think they're coming?
I think at the earliest June, it's going to continue to be very data dependent. And, they may not, be looking just at earnings, but I think those rate cuts could start in June, and we could still see a number of them this year. But again, I think you need to look at some of these longer term indicators. I think this thought process that the only way to stick a soft landing, the only way for the markets continue to grow this year is if we have rate cuts. I'm not actually convinced that that's true. I think the market's doing well. Economy, we're seeing some great earnings reports, and the consumer in large part is still spending. Until that spending comes down, I just don't think we're going to see cuts.
I see. Talk about some of the risks that maybe you're a little worried about.
Yeah, I think the big risks are, this cut situation. If the market is completely dependent on Powell cutting the rates and they take that data dependent approach, we may run into some issues. The other thing I think we have to look at right now is we're running a budget deficit that's this large with full unemployment, and that's never happened. Inflation is still a real nagging problem to consumers. If debt and inflation isn't dealt with, then we're going to have to pay the piper some way, right? And that's either going to be in long-term rates rising or the dollar weakening in the form of purchasing power. So we have to watch that. Generally, these kind of debt to GDP ratios in the area that they are tend to happen when unemployment's high, right? When we have economic problems, but we're essentially at full employment and we're still running this massive deficit. And I think long-term, that could be really problematic.
When you talk about investing or planning a portfolio, what are you telling folks here?
I think right now you really have to pick well. I still think there's some opportunities in technology. Everybody's talking about the Magnificent Seven, or maybe it's the Strategic Six. I don't know what acronyms we want to use, but I think there's still some opportunity there. When you look at some of those, yes, some of the PE ratios are getting a little bit high, but not compared to where they could go from a growth perspective. If you look at the PEG ratios, profit, earnings, and growth, technology continues to look strong, even though they seem like they have a high price tag. So historically, maybe not so high when it comes to growth. So I think there's some real opportunities there, but there's also plenty of risks that we have to watch out for. There's uncertainty surrounding the U.S. economy. If we're going to stick this landing, the presidential election looming, lots of risks that we want to keep our eye on that could tame the bull market, but there's a lot of opportunity as well. So you want to pick, and you want to pick carefully, as we're seeing today in some of the retail names, big downgrades and some struggles in that sector, but there's still some opportunities in others.
Yeah, how do you feel about earnings season so far? I mean, we've had a lot of revised earnings. Those revisions being a little easier to beat, but a majority of the companies, about 75% of the companies, have been beating. So that's pretty good, right?
Yeah, that's really good news, but I think you bring up a great point. If we look at it, they really pulled back their forecast last year. So we're beating a very reduced goal line, if you will, but it's still always great to beat. I think that's part of what's building some of the confidence for retail investors in particular, is those earnings reports just feeling good. People are still spending, and that's really driving some of the buying that's been happening.
Right. It's great to see you, Tony Drake. Drake and Associates, many thanks.
Thank you.
Coming